Good afternoon, everyone. Thank you for joining us today. Today's webinar topic is on new 2025 tips and limits to optimize your financial future. Before we begin, just a couple things. We are recording today's session and we will send it out. So don't feel like you have to take notes. We'll send it out to you and post it on our website as well. And then secondly, if you do have questions, we don't have time for them today, but please do reach out, give us a call or email us. We're happy to chat through any questions that come up from this presentation. My name is Heather Jordan. I'm the Managing Director for TrustPoint's Emerge 360 division. We work with folks on investment management, financial planning, and I'm also a CFP or Certified Financial Planner.
Hi, everyone. My name is Brett Sebion. I'm the financial coach at Emerge 360. Work with a lot of individual clients as well as do all of the education for the TrustPoint 401k plans.
And I am Brenna Johnson, and I am a financial planner with the TrustPoint wing, but I also do planning for Emerge 360 clients, and I also am a certified financial professional.
Before we begin on our content, just want to jump into kind of who TrustPoint and Emerge 360 is and what we do in case you haven't attended one of our presentations before. So Emerge 360 is a division of TrustPoint. TrustPoint has been around for over 110 years now. We're headquartered here in La Crosse, Wisconsin, and we also have an office in Eau Claire and Minneapolis. Across all of our departments, divisions, we manage about $8 billion in assets under management. I point that out because we're large enough to have a lot of different resources and really great expertise on staff, but still small enough to be able to provide personalized service for our clients and provide kind of these educational webinar sessions for clients and community friends to attend to learn more about financial wellness. Aside from education, which we do a lot of financial education, we do quite a bit with different trusts and estates. We have a wealth management and investment department, retirement plans, foundations, nonprofits, a family office, and then most recently we launched Emerge 360 back in 2021 with the purpose of helping people with investment management and really expanding who we can offer financial planning to. So today we're going to cover a couple different things and I'll jump into our agenda on the next slide. We will be covering the new limits for 2025, so new 401k limits, IRA limits, HSA limits, all of the numbers to get you ready for this new year. And then a couple different new year tasks of things to think about, consider as you're thinking about starting the new year and building out your own financial plan. So I'll hand it over to Brett, and he's going to start with our new limits for 2025.
All right, thanks, Heather. So as Heather said, we'll cover the new limits for 401ks, IRAs, talk a little bit about HSAs and gifting as well. So these limits generally change year over year, which is why we always want to give this presentation to make you all aware of what those limits are. Like I said, they generally go up a little bit year over year depending on what age you might be. So the new limits for 2025 in regards to 401k contributions are as followed. And as a reminder, 401ks really are the most productive vehicles to max out retirement savings. The limits are higher. There's no income, restrictions like there are with individual retirement accounts, which we'll get into on the next couple slides. But under the age of 50 for 2025, you are able to put up to $23,500 of your own monies into the 401k plan. This is separate from employer contributions. If you're age 50 and older, you're able to make what's called a catch-up contribution of $7,500, bringing that total to $31,000. There is a new catch-up amount in regards to the SECURE 2.0 law that was passed. If you are age 60 to 63, there's a little bit more, I guess I'll call it like an enhanced catch-up that brings that traditional catch-up from $7,500 to $11,250 in 2025. So if you're in that sweet spot and you're looking to really kind of additionally max out your retirement savings, it's $34,750. Again, this is of your own monies, regardless of the company contributions. One of the other things we talk about with 401k contributions is, selecting a percentage of your compensation or a dollar amount. Selecting a percentage really, makes it easier when you're trying to increase your 401k contribution year over year. There are plans where it does make sense to set an actual dollar amount, especially if you're looking to max out your 401k and you want to keep the dollar amounts going in there consistent throughout the pay periods, whether it's once a month or twice a month, et cetera. So each plan is a little bit different in order to, if you can select a percentage of your comp or a dollar amount. Majority of folks, we really encourage the percentage just so it's easier to kind of keep track of and to increase that contribution year over year. IRAs. So new limits for 2025. If you are under the age of 50, you can put up to $7,000 into an IRA. If you're age 50 and above, you can put up to $8,000. So that $1,000 catch-up contribution. Remember, there's a couple kind of important things to remember on the income side when it comes to contributing to an IRA. So there's income limits for the tax deductibility for traditional IRA contributions, and there's income limits to flat out contributing to a Roth IRA. Regardless of how many IRAs you have out there, this is the income limit. So if you have two IRAs, you can't put 7,000 into one and 7,000 into the other. For both of these, you must have earned income. And with these, you can fund until April 15th of the current year for the previous year. So for example, if you have an IRA opened right now, you have up until April 15th of 2025 to make a 2024 contribution. So that's a little bit different than on the 401k side, that you can't do. That's specific to the IRA side. And remember, you can max out both your 401k and IRA. But those limits apply to all of the IRAs that you have out there. But you are more than welcome to max out on the employer plan and also the individual retirement account. So next we'll cover specifically some of the income limits when contributing to traditional and Roth IRAs. So first, the traditional IRA. Again, there's income limitations for receiving the tax deduction for traditional IRA, contributions. I will say off the bat, if you are not an active participant in an employer plan, you're not contributing to an employer plan, these income limits go away. So again, the industry is gonna not have you bound by these income limits if you're not tied to an employer plan. But if you are, which I assume the majority of folks on here today are, there are these income limits. So we'll go over the first one. Single taxpayers participating in employer plans. The phase out range rises to 79,000 to 89,000. These limits also go up year over year. So again, single taxpayers participating in employer plan, it's those amounts. If you are married filing jointly and participating in employer plan, that phase out range rises to 126 to 146,000. And then married filing jointly, not covered by an employer plan, with a spouse as an active participant in an employer plan. So a little bit of a mouthful there. The phase out range rises again from 236,000 to 246,000. So it's important if you're working with a financial advisor or a CPA, your tax professional, to make sure all of this is fitting together and you're able to contribute to the buckets that the IRS allows you to. So that is in regards to the traditional IRA. Next, we'll talk about the Roth IRA. So Roth IRA income limitations for determining the maximum contribution. So married filing jointly, the phase out range rises from 236 to 246. And again, all of these figures are, and I should have said at the beginning, are modified adjusted gross income, so your MAGI. And then single filers and head of households, the phase out range rises from 150,000 to 165,000. So again, want to stress, if you're working with a financial advisor or a tax professional, to make sure that you have all these limits in your back pocket and making sure you're doing everything correctly. For individuals who exceed these income limits, but they still want to kind of fund that Roth bucket, on the IRAs, you can do what's called a backdoor Roth contribution, where you have a traditional IRA, a Roth IRA. You make a non-tax deductible contribution to the traditional IRA, which is kind of backwards, right? The reason we contribute to that account is to get the tax deduction. But for this specific strategy, you make a non-deductible contribution and then you just convert it to the Roth IRA. So we do that with a lot of our clients who want to fill that Roth bucket. But again, if you're participating in the 401k plan, these do not exist, right? So you can make well over these amounts and still contribute to the Roth portion of your 401k account. Next, HSA. So HSAs, or health savings account, are a very powerful tax advantage vehicle for folks to save for current and future healthcare related costs. You have to be participating in a high deductible health insurance plan in order to contribute to this type of an account. The biggest advantage of this, again, comes on the tax side, and it's actually a triple tax-free advantage. You do not pay taxes on the contribution. The growth in the account, if it's invested in any capacity, is tax-free, and then it's tax-free distributions as long as it's used for a qualified medical expense. So if you're under the age of 55, the employer plus employee max contribution is $4,300. For a family, it's $8,550. So a lot of employers, if you're on a high deductible health insurance plan, contribute to the HSA account on behalf of the employee. So make sure to take that into consideration when you're figuring out how much you want to put in, especially if you're looking to max out, to calculate that difference. And then if you are 55 or older, those limits go up as a catch up. So self only 5,300, family 9,550. But again, you have to be participating in a high deductible health insurance plan in order to be contributing to this HSA. But it can use to be cover, deductibles, out-of-pocket costs, and the balance never expires, right? So you can, if you have a balance at age 65 when you start, being on Medicare, you can use it for Medicare premiums as well. So it's not a use it or lose it. It can be used for current deductibles and out-of-pocket future healthcare expenses as well. So very powerful vehicle. And then last slide for me before I kick it off to Brenna has to do with gifting. So again, these numbers can generally increase over time, but these are the gift tax limits for a single person and married person. So 19,000 if you're single, 38,000 if you're married, before you have to file a gift tax return. Okay, so I could give Heather $19,000, gift her $19,000. I could, gift Brenna $19,000. But the second I go over that limit, I have to file that gift tax return. And then last bullet point there, unlimited gifting to spouse or qualified charities. So that's all I have. I will kick it over, I should say, to Brenna.
Thanks, Brett. So now we'll go through some of those New Year's tasks that we like to remind people to do at the beginning of every new year. So the first thing we want you to be looking at is your budget. There's what we call the 50-30-20 rule. So what that means is 50% of your budget should be used for needs. Those needs include things like housing, food, your medical, transportation, and any debt payments that you have. Your wants are going to be 30% of your income. So that's going to cover things like your eating out, your traveling, your entertainment and clothing. And then your savings should be 20% of your budget. That's where we want to build that emergency fund. We want to be contributing to retirement accounts or IRA accounts. And then anything else too, we want to be paying down on that debt if it has a high interest rate on it. Generally speaking, if you have debt above 6%, that's what we want to try and tackle first. So if you have a high interest credit card or something like that, we want to be putting as much money as we can towards that so we can be reducing that. And then just another thing to remember is if your needs are more than 50% of your budget, we want to pull back from the wants portion. not the savings portion. So we want to make sure that we're always saving for the future. We're saving for that rainy day. We're saving for when the car breaks down, when you're on your way to get the refrigerator part from the store. So those are the things that we want to make sure that we're building into your plan so that you can make sure that you have those funds for falling back on so that we don't have to rely on credit cards. The next thing we want to have you guys review too is your beneficiaries. So we want to make sure beneficiaries are up to date because they override a will. So that's kind of a common misnomer is people think, oh, I have a will, my stuff will just go to what my will says. Well, that is true, but that means it has to go through probate first. So what we're trying to do is come up with ways that we can get your assets to go to beneficiaries without having to go through probate. The way to accomplish that is by having beneficiaries on your 401k or 403b accounts, your IRA accounts, any kind of taxable accounts, that type of thing. One thing we also want to remind people of is make sure that if you have any life changes that you update that. You know, we've had people that have gotten a divorced. They have the 401k from when they were first married. They got divorced. They forgot to change it. If anything happens to you, those funds will go to your ex-spouse, whereas we want to make sure that it's going to who you currently want them to go to. The other thing that you can do is to ensure your bank accounts have what's called a payable on death designation or a POD. What that means is if something happens to you, your heirs can walk into the bank with a death certificate. They change the account from your name to your heirs' names. It's easy peasy, and there is no taxable event at that point. There's no probate that you have to deal with. So that's a nice, easy way for you to be able to ensure that your heirs are able to access funds after your passing as quickly as possible. The other thing that a lot of people aren't aware of is a transfer on death deed for your real estate. So in Wisconsin and Minnesota for sure, you're able to put basically a beneficiary on any sort of real estate that you have. We do recommend this be done with an attorney. We don't want you to be putting your neighbor's house because you put a wrong legal description or something like that. So that's definitely something that this one we would want you to refer to an attorney for. But you're able to have any property that has basically a tax bill. You're able to put a beneficiary on that and pass that down to whoever you would care to pass that down to. And again, we want to remind everybody that anytime you have life changes, let's review these. I mean, the first of the year is always a good time, but in the middle of the year, if you have a marriage, a divorce, a job change, any new children, adopt any children, or if there's a death in the family, we want to make sure that we're making sure that the beneficiaries are up to date to what we want. The next thing that we'll look at is your emergency fund. So this is what we were talking about earlier with the having funds on hand so that if something catastrophic happens, we have a safety net. So we recommend 3 to 6 months of living expenses in liquid savings, which is like a checking or savings. That's generally if you have a dual income household. Chances are if you have a single income household, you'll probably want that to be more like a 6 to 9 months, maybe even 12 months, depending on if you have children or not that you're caring for as well. So that's something to keep in mind, you know, putting $50 a paycheck, $100 a paycheck, it doesn't have to be a lot, but we just want to start building that fund because if we have that fund, chances are things won't happen as much as they would if we don't have any kind of a safety net. The next thing you can do is once you have those 3 to 6 months of expenses saved into just like normal liquid account, you can invest in a second tier savings account. We call them here at TrustPoint agency accounts. They can be called a non-qualified account. And basically it's a separate type of a brokerage account that we put into a more conservative investment. At this point, we're wanting to put it in a conservative investment because we may need to reach those funds in a short time period. So we want to have that account open so that we can start saving into that. And then as we get closer to retirement, it's great to have this third bucket of funding, you know, your regular cash savings, your retirement accounts, and then this is the third bucket. Because as you're looking at retirement, if you want to retire before 59 and a half, you can't access your retirement accounts without paying a 10% penalty for early withdrawal. So this is a great way to kind of bridge the gap if you want to retire before 59 and a half. If you're looking at bridging between, let's say 60 and 65 and you have some medical concerns, you know, we can work with this third bucket to kind of work on non-taxable or minimal taxable income, as opposed to pulling everything out of your retirement accounts that is charged at regular income rates. Related to that, we will look at funding our IRAs. As Brett mentioned earlier, you can fund those until April 15th of this year for your 2024 contributions. And as he mentioned as well, we want to make sure that we are just using that $7,000 as all of your IRA or Roth contributions. We can't have separate amounts of $7,000 into each account. And then we also want to make the point of saying, even if you're maxing out your 401k, you can still max out an IRA as well. Having that extra savings is always a good thing to have in your back pocket. So what are some ways to increase your retirement savings? Well, as Brett mentioned earlier, increasing that percentage every year. Even if you have 3% and you get a raise, then that's going to get more into your account. Maybe we go from 3% to 4%, and we gradually increase that to 10 or 15%. Any debt that you pay off, let's start rolling that money into extra savings, whether it be into retirement savings or into that non-taxable account. And then we also want you to remember that you need to kind of sometimes take the emotion out of what you have. Sometimes paying off a debt, you feel fantastic. You pay off the debt. Oh, what can I spend my money on? We want you to kind of take that step back and say, okay, how can I utilize this money best to accomplish my current goals and also my future goals? Our next slide will kind of go through how those changes can impact the amount that you're saving. So we've got Jordan and Jamie. Jordan is in the blue and Jamie is in the green. They both work for the same company, earning the same salary, participate in the same plan, and they're both age 35. So their company matches 50 cents on the dollar, and they earn a 6% average on their investments. So you can see with Jordan just contributing 2% of his pay each year for 30 years flat, you can see how the blue line, it goes up, but it doesn't go up dramatically. So that starts at $13,000 after 10 years, and it ends up being $102,000 after 30 years. So now we'll look at the green column, which is Jordan, who increases her deferral by 1% each year, just until it reaches 10%. So after 10 years, her amount in her retirement account will be $42,000. And after 30 years, her retirement account will be about $428,000. So you can see it's 4 times the amount just by increasing by that 1% each year and stopping at 10%. So we want to make sure that you guys are thinking about the fact that, if you think of 1% of your paycheck, it very well may not be as much as you think it is, especially if it's before taxes. So if you don't see it, you may not miss it. So that's the point where we're trying to make. We're just increasing that 1%. You may not even miss it. And then look at how much more you have to work with in your retirement. We've got 2 more examples here. We've got a 40-year-old with a $50,000 salary and $50,000 already in their 401k account and a 7% annualized return. So this first example is a 5% contribution rate until age 65, which over the years that results in an account value of about $435,000. So we're going to take that a step farther, and the next slide will show increasing at 1% until they stopped contributing at 15% of their income. And you can see that the account value greatly jumps up, and we're at the $643,000, which is $208,000 more than in the previous example. So when we're looking at those small changes really can make a huge difference, especially when you're looking at retiring and you want to make sure that you have the funds that you want to be able to do the things that you want in retirement. And I will kick it over to Heather now to kind of wrap everything up.
Awesome. Thanks, Brenna. And great job, Brett and Brenna, covering all those new limits and new tips for the new year. If you do have questions, please do reach out to us. Emerge 360, again, is a division of TrustPoint, and we are here to help. As mentioned at the beginning, we do work with folks on investment management. When they have assets 50,000 and above, we provide investment management and ongoing financial planning, which is really nice, regardless of if you're entering retirement or if you're a little bit younger, just wondering and having questions on debt management, budgeting, savings, things like that. all of that goes into financial plan. So we'd love to meet with you, have questions, or if you want to learn more. There are a couple QR codes on the screen. The first one is a link to our new website. We got a new website about a month ago. It's really, really great with a lot of great tools and resources on there for different financial planning topics. And then the next QR code is to sign up for our newsletter, where we do monthly different kind of educational topics on different financial planning pieces. So feel free to scan those if you're interested. So thank you everyone for attending today. Again, we did record this, so we will be sending it out and posting it on our website. If you do have questions, please do reach out to us, email us, call us, stop by the Trust Point building. We're here to help and answer any questions that you have. So thank you for attending and enjoy the rest of your day.